Well, thank you, Jason. A perfect batting average, Walt. Thinking back to playing high school baseball, my father would be so proud. Again, this is my fourth year presenting, and this event just keeps getting better and better and bigger and bigger. And so I'm really happy to be here. It's been so nice catching up with so many of you. As usual, what I'd like to do today is I'd first like to give you sort of a recap of last year's economic news, sort of a 2019 economic year in review. That'll lead into my forecasts for 2020. And I always like to leave you with something to sort of think about and chew on as you walk outside of the room. And so I'll close with that this morning. So when I think about the big economic headlines for the year, I think number one thing that I'll remember has to do with the U.S.'s number one trading partner, which is China. And so 2019 saw a general ratcheting up of tensions and threats and counter threats throughout the year. It closed in December with, frankly, both sides sort of reaching the precipice and then looking and saying, let's step back. How that plays out, I don't know that anything was really resolved at the end of the year, but how that plays out, I think, will be one of the more interesting things of 2020. China's the U.S.'s number one trading partner, Canada's number two, Mexico's number three. So my second headline for the year is the negotiation of the USMCA. I don't know how long it's going to take for that acronym to stick, but that's the new NAFTA. And so that's the new trade agreement for the North American economies. And again, I think renegotiating that was my number two headline for the year. And I think my number three thing that I'll remember for 2019 is the number of states that sort of rushed somewhat headlong into the legalization of sports gambling and marijuana. And I don't think that this reflects libertarians taking over the state houses across the country. I think what it really reflects, one thing it reflects is a Supreme Court case from a couple of years ago that opened the door for legalized sports betting. But I think what it really reflects is a decision of state houses to try to look for other sources of revenue, sources that are more popular than the traditional sources of income taxes and sales taxes. And I think this idea of legalize it but then tax it, I think this is something we're likely to see more of in the near future. Okay? In terms of the numbers, well, a year ago, my forecast, the way I described it, was that in 2019 we'd take the foot off the accelerator but not touch the brake. And I think that's about what I think we saw in 2019. 2019 U.S. GDP, real GDP, grew at 2.3%. Illinois state GDP, at least through the third quarter, is growing at 1.6%. Both of these numbers are smaller, slower growth than what we had seen the previous year. Again, a slight slowdown in 2019, but again, numbers that are fairly consistent with what we've seen really for the last 20 years. These were sort of typical years for the 21st century. In terms of labor markets, unemployment continued to drop, really to historic levels. The U.S. national unemployment rate for the year was 3.7%. You'd have to go back to 1969 to have a lower unemployment rate than this. And as I always feel I need to point out to people when I give that year, let's remember that in 1969, over 250,000 young men were drafted through selective service, right? So over 250,000 young men were taken out of the labor force pretty much every year in the late 60s. So to have 3.7% unemployment during peacetime without a draft, that's again a historically low number. Illinois, the state, saw its lowest unemployment rate since the year 2000. Madison County is its lowest unemployment rate since 1999. So again, historically low unemployment rates. You can see I have Edwardsville unemployment rate the lowest at least since 2010. We just can't go back any further. There was a major revamp in the way that the Bureau of Labor Statistics measures the local unemployment rates in 2010. So we just can't go back any further with comparisons. If you're getting your end of the year statements from your financial advisor about your 401k, most of you, I suppose, are getting good news. The stock market had a really good year. The S&P 500 was up about 30%. Again, other indices were up similar amounts, so it was a good year for our retirement funds and for the stock market, which of course leaves us all asking what's in store for 2020. So before I give you my forecasts, I'd like to give a little perspective of this current expansion. Okay? The U.S. economy now has been growing for 22 consecutive quarters, over 5 years. This isn't a record, but as expansions go, this is a fairly long expansion. It's now been going again for over 5 years. In terms of labor markets, it is a record. Okay? We have now added jobs to the U.S. economy for 111 straight months. That's not only an all-time record, it's more than double the previous record from the late 1980s. Okay? So again, month after month, adding jobs to the U.S. economy, again, for 111 consecutive months. That's a record, and again, it's more than double the previous record. When I was in grad school, unemployment of 5% was called full employment. It essentially meant that an unemployment rate of 5% meant, for the most part, anybody looking for a job, for the most part, could find a job. And we've had unemployment at 5% or lower for 39 consecutive months. Again, not a record, but again, a long time period with historically low unemployment. So when I look at the numbers, I see a number of things that make me fairly optimistic. And the things that make me optimistic in 2020 are largely things having to do with consumers. So let's remember that personal consumption accounts for about 2/3 of the economy. So if consumers are feeling good and they're spending money, that's a good sign for continued economic growth. And the numbers seem to indicate that consumers are feeling good and they're spending money. Consumer sentiment is at a relatively high level, a level that historically has been consistent with continued economic growth. When we look at retail sales and housing numbers, again, those things are at strong levels that historically have indicated continued economic growth. And so again, I look at these numbers and I feel like 2020, I don't see too much to be pessimistic about, which is why I am still fairly optimistic. Now, if you ask me, well, is there anything, Tim, that's flashing yellow on your dashboard? The answer is, yeah, there are a couple of things that are flashing on the dashboard that I'm certainly keeping an eye on. The first is something that's going on with interest rates. Now, if you were here last year, I talked about this. Don't worry, I'm not going to repeat it. I learned my lesson. I'm not going to talk about interest rates again. But there are things that we see in sort of interest rate spreads that historically have been precursors of recessions. Now, the bad news is these things have been there, sitting there for over a year. The good news is they've been sitting there for over a year, and they haven't seemed to have had much of an effect yet. Okay? Some folks are thinking that maybe these interest rate spreads aren't telling us the same things that they used to tell us historically, and that's why they haven't led to a recession yet. But again, it is something that I'm keeping my eye on. More troubling to me is towards the end of last year, the Purchasing Managers Index began to drop. Now, the Purchasing Managers Index, it's the results of a survey of purchasing managers, and these folks would be on the front line of the economy, looking at factory orders and things like that. So what they see going on is generally taken seriously. And at the end of last year, these survey results started dropping down to levels that we haven't seen since the Great Recession. Now, the conventional wisdom as of now is that many of these folks were concerned about the escalating trade tensions with China last year, and that they were concerned about worst-case scenarios. And again, the conventional wisdom is that hopefully, as the truce has been called, if the trade spat with China can come to a conclusion this year, that these folks will start feeling more optimistic, they'll start feeling better, and that this won't again be a precursor for a recession. But again, that's one of the things we'll be looking at in 2020. Okay. Again, put it all together in what are my forecasts? Well, first of all, the usual disclaimers. My forecast model is it's a quantitative ensemble forecast. What that means is it looks at trends, patterns, correlations. What it really means is I'm not trying to predict the election and what that'll mean for the economy. I'm not trying to predict what's going to happen in Iran or North Korea this year and what that might mean for the economy. I'm not trying to predict what's going to happen with the coronavirus. I don't look at those things. I look at the economic data, and when things start showing up in that data, that's when it starts showing up in my forecasts. The other caveat is it's always changing, right? New data roll in every day, every week, every month. I update my numbers, so if you see me speaking a month from now, you might hear different numbers, and that's why. Okay. All right, so what are my forecasts for 2020? Well, if a year ago my metaphor was taking the foot off the accelerator but not touching the brake, then what I would say for this year is continuing to coast. I would describe it quickly as more of the same. My forecasts for 2020 is 2.1% economic growth, which would be just a shade slower than 2019, but essentially in line with what has become sort of average growth rates for the last 20 years. Also fairly typical for the last 20 years, my forecast for Illinois, 1.8%, just a shade slower than the national growth rate. So those would be my forecasts for 2020. If you're curious how my forecasts compare to other folks, here's a table showing some well-known forecasts. For the most part these days, we're all sort of clustered around 2%, give or take just a little bit. Again, this isn't especially optimistic, it's not especially pessimistic. I'm on the slightly optimistic end of these forecasts, but for the most part, we're all looking at the same data and we're all seeing economic growth in the neighborhood of about 2%. Again, this would be a little bit slower than last year, but again, pretty much in line for what we've been seeing fairly consistently for most of the last 20 years. Okay? All right, so those are my forecasts. I am showing about a 16% probability of a recession this year. The Wall Street Journal is, they're more pessimistic than I am. They're looking at a 26% chance. Again, I think most of the data look like this is making out to be just sort of a typical year for the national economy and the state economy. Okay? All right, well, again, I always like to spend the last 5 minutes or so giving you something to chew on and something to think about as you walk out of here this morning and for the next couple of months. And so I'm going to start by telling you something that you already know, I think, and that's that this country's population is getting older. Okay? Right now, well, obviously all of us are getting older, but no, this is the population as a whole. Okay? Right now, there are about 50 million Americans that are 65 years of age or older. Okay? The Census Bureau projects that number in the next 20 years, that number is going to rise from about 50 million to about 80 million. Okay? So by 2040, they're projecting, again, an increase from about 50 million to about 80 million. If you prefer to think about this in percentages, right now about 15% of the US population is 65 and older. And the Census Bureau projects, again, the combination of the aging of the baby boom, improved medical technology, that this number is going to increase over the next 20 years from about 15% to about 22%. You stretch that out a few more years to about 2050, and we're closing in on having about a quarter of all Americans be seniors, 65 years and older. Okay? And for this morning, when I use the term seniors, I mean 65 and older. Okay? Now, again, my guess is you knew on some level, you knew about these numbers. And my guess is you've probably read something about how these numbers are going to affect the economy. And my guess is that if you've read or heard anything about this, that it's been fairly pessimistic. Okay? So here's what I hear and what I read when people talk about the aging of the US population. I hear about falling stock prices as we cash out our 401ks. I hear about worker shortages as people move into retirement. I hear about collapsing housing markets as folks downsize. And I hear about groaning healthcare infrastructure. That's literally the word I almost always hear, is the word groaning. I guess it's seen as just the perfect word for what folks are anticipating. And I guess what I'd like to present to you this morning is, first of all, I guess a voice of optimism, right? That I maybe am not as panicked about this as a lot of folks are. And then beyond just being a voice of optimism, offering up maybe a suggestion of where this might provide an opportunity for our community and for our region, okay? Now, let me start by saying I don't doubt that all of these things are going to be affected by the aging of the U.S. population, right? I have no doubt that equity markets, housing markets, labor markets, the healthcare sector, that the aging of the U.S. population is going to affect all of these things. I guess the reason I'm not sort of in a panic about it is I'm confident that these markets and these institutions are going to do what they've always done, which is to adjust. Okay? Why am I confident that the housing market and the housing industry will adjust to the aging of the baby boomers? Well, because the housing industry has been adjusting to the baby boomers since the 1950s, when their parents wanted to buy houses that had more bedrooms, right? Why am I confident that U.S. labor markets are going to adjust to the aging of the baby boomers? Well, U.S. labor markets have been adjusting to baby boomers since the 1960s, when baby boomers started entering the labor market, right? So none of these things is going to come as a shock or a surprise to these institutions and markets. They've been adjusting to the aging of the baby boomers for over half a century, right? And so I'm convinced that markets and institutions will do what they do often fairly well, which is to adjust. There will be adjustments, but I'm convinced that it can happen. Okay? I'm reminded of one of my favorite quotes from Hamlet, that nothing is good or bad but thinking makes it so. And I think that to some extent we can look at this in panic, or we can think about how we might turn this into an opportunity for our community and for our region. So let me share some other numbers with you about seniors. And again, I could have divided it out, but in the interest of just having a nice short presentation this morning, I'm lumping everybody together who's 65 and older here. So this includes my 66-year-old brother, and it includes my 95-year-old mother. So anybody over the age of 65 is included in these. So what else do we know about seniors? These are all census numbers. 29% of seniors have a bachelor's degree or higher. They're fairly well educated. 20% of seniors are still in the labor force. Okay? 46 of working seniors are in a management, a business, a professional, or a financial occupation. Okay? Among those that are working full-time, over half, 56% of seniors, have an annual wage and salary income. So that's wage and salary, doesn't include pensions or Social Security, but regular old sort of take-home pay from the job. Over half have a wage and salary income of at least $50,000. Okay? Among U.S. households that are headed by a senior citizen, 43% have a total income of more than $50,000. Again, that would include pensions, Social Security, and things like that. If we look at family households headed by a senior, so households that have at least two members, so typically a husband and wife, but two members, 60% of those households, senior households, have a family annual income of at least $50,000. So I look at this and I think this is an opportunity. I think these are people whose spending power I would like to have in our community. I would like to have here. Okay? And so I would like to sort of, if not exactly a challenge, I'd like all of us to think about what we can do, whether business owners, academics, nonprofits, or government in this room, think about what we can do to try to make our community an attractive place for seniors to want to retire. Now, the first reaction I often get to this when I say this is a laugh, and people saying, well, how are we supposed to compete with Florida or the Carolinas or Arizona with their year-round golf and their beautiful weather? And of course, I'm honest. if you want to go out on February 4th and play golf in short sleeves, well, Edwardsville is probably not the place to do it, right? But we don't have to have year-round golf to be an attractive location for seniors, right? And in any case, folks can live here and still take their golf vacations elsewhere, right? So if that's who we're concerned about, we can still be an attractive place. And so what is it that seniors actually want when they're retiring? So I've been reading essentially everything I can get my hands on about this for the last year or so. And of course, there are as many opinions of what seniors want as there are seniors, right? But I see three recurring themes. And before I show them to you and ask you to think about them, I think many of you are going to have the same reaction that I do when I look at this list, which is that I think we're off to a pretty good head start here in our community. And that maybe what I'm proposing here isn't a call to action as much as just a suggestion that we think about what we can do to maintain the momentum of being a place that seniors would like to retire. So what are the big themes that I see when I read about these surveys? Well, I don't think any of them will surprise you. Number one, seniors want to downsize, but they still want amenities. What you keep seeing is things that seniors might not want 3,000 square feet that they have to worry about taking care of, but they'd still like a nice kitchen, right? Seniors might be downsizing from 3 family cars to 2 family cars to 1 family car, but they'd still like a garage to park it in, right? And so again, having the appropriate types of housing that seniors are interested in living in, I think that would be one way we could be attractive. Seniors want to remain, what they all say is that they want to remain physically active. Again, maybe not a pool in the backyard that they have to maintain and repair, but access to a community pool or other things like fitness classes or places to walk indoor and outdoors. Okay? Seniors want, of course, to remain mentally active, and they want a community that helps them do that. Well, whether it's being able to remain employed or volunteer work or cooking classes at the local grocery store or continuing ed classes at the local university. This is what seniors say that they want, okay? And again, when I look at these things, I think about our walking trails, I think about our affordable housing, I think about our colleges and universities in the region, and I think we're off to a good head start. And again, I don't think we need to turn the community upside down to reflect these desires. I think we just need to keep up the momentum, okay? All right, and so anyhow, so I hope that gives you something to think about as you leave here this morning. And we've got, again, I'm either the warm-up act or the court jester. I don't know which one, but anyhow. So we got some great speakers, so I don't want to take up any more of your time. I'll be around after the other speakers. I'd be happy to share thoughts with anybody afterwards. And so thank you so much for your attention, and have a great morning.